Welcome to Simplify My Numbers, the show for the 765 entrepreneur. 7-figure revenue, 6-figure take-home income, and 5 figures lost to taxes every year. If that sounds like you, you're in the right place. My name is Fabrice. Each episode, we break down real tax planning strategies that help 7-figure business owners legally reduce taxes and keep more of what they earn. Let's stop guessing and start planning your taxes on purpose. Let the show begin. 7, 6, 5, 4, 3, 2, 1. The Simplify My Numbers podcast is for informational and educational purposes only. All right, here's another episode of what I like to call Fabrice Reacts. I love to always find out different things on social media, that people might say. I answer clients' questions from time to time. I get texted different videos and asking if this is legal. Is that something I can't do? But sometimes my producer also shows up with more content. And so we'll do another one of those and see what we can find. All right.
Really annoying rich people's secret I learned on Wall Street. The wealthy obsess over taxes because ownership changes the math completely. Example, an employee makes $300K salary. After federal taxes, state taxes, payroll taxes, they might keep closer to 170 to 190K, depending on where they live. Now compare that to somebody who buys a boring business. Let's say you buy an HVAC company doing 1.5 million in revenue with 300K in profit. So it's the same sort of profit to salary. Here's the difference. Now you have depreciation from trucks and equipment, interest deductions from the SBA loan, software and marketing expenses, healthcare deductions, travel and vehicle expenses, home office deductions. So even though the business makes 300K in cash flow, your taxable income might show closer to 150 to 180K after deductions and depreciation, meaning the employee and the owner both made the same amount of money, but the owner keeps dramatically more of it while also building equity in the business itself. Employees get taxed first and spend what's left. Business owners spend on growth first and get taxed on what remains. That's why so many wealthy people rush to owning cash flowing businesses. The tax code actually rewards ownership. I'll actually break this down live for you if you want.
All right. So that's a great video and great concept. And I mentioned in another video before where I said that employees pay taxes and then spend, while business owners spend and then pay taxes. And the whole idea about it is that as an employee, you're getting taxed on your gross income coming in, and then you receive the net to go ahead and take care of your personal expenses. And the business owners get the opportunity to reinvest in their business before their net profit is determined. And that is the number that they get taxed on. Now, here's the issue. One thing that she's not mentioning in the video is the difference between actual expenses that take cash, right, out of your business versus phantom expenses, right? So here's the difference, because in the breakdown that she gave for the business owner, she's mentioning things like advertising, right? Marketing expenses. I believe she mentioned something about insurance, if I'm not mistaken. And so, or interest on the business loan. Well, those items are actual items that are taking money out of the business. So in other words, you're actually spending those dollars and your net take-home income changes. That is different from depreciation, which is a phantom expense. Right? Because depreciation is something that you get because you already own that asset. You would have already purchased an asset either with debt or your own money, but most of the time with debt. And essentially, you would get the depreciation expense to reduce your taxable income without money actually leaving the business. Those are the expenses that you want to be able to focus on. During your tax planning strategy, the idea is to essentially identify all the expenses that you can either reimburse to yourself. So things that you would normally already pay for. Like, for example, if you're an employee, you can't really write off your home office. You can't really write off your mileage going to work. But as a business owner, you can reimburse yourself for those items, right? And so in other words, money that you're already spending and already benefiting from becomes a business expense. So you're reimbursing yourself and it reduces your taxable income. At the same time, you can even reimburse yourself for health insurance, right? And depreciation is another expense that you would get without necessarily having to spend the cash. So that's what you want to identify. As long as you're doing that right, yes, as a business owner, you would definitely dramatically reduce your taxable income compared to what an employee is able to do. All right.
I asked a CPA this, is having a podcast the greatest tax play to be able to write off a vacation? And he was like, I said, most tax strategists are saying start a travel vlog YouTube channel, which like you got to go to the restaurant, you got to go to the hotel and make a review. That's not fun. But if I go to a city and I use podcasting to market my business, isn't that trip a deduction? And he said 100%.
Wow.
And so I was like, so if I go, which I've been doing, it's either I'm tax evading or I'm like playing the game. He's like, we can go to Cabo and link up in Cabo and have a conversation. I was like, so that makes that like one element in your business unlocks a whole unlimited opportunity of writing off trips.
Incredible.
And he said, podcasting is the greatest business write-off strategy right now.
Okay, so I would be extremely careful with this one. And here's what I mean. So when it comes to business travel, there's two things that are extremely important: intent and time spent, right? So the purpose of the trip has to be for business first, not leisure. So it depends on how you structure the facts. The purpose of the trip has to be for business first, for that to be a business expense, right? And then the time, at least 50% of the time that you spend on that trip is supposed to be related to that business purpose. So the idea that you would simply travel to Hawaii, shoot a podcast video that takes you maybe 3 hours, and then write off 100% of that trip, I can almost guarantee that the IRS will frown upon that and probably remove it as a legit tax write-off. But instead, one of the things that I usually tell my clients is we have to prove intent before it happens, not after the fact. And so if you're going to take a business trip, I want you to send me a confirmation by email with a short explanation. Hey, Fabrice, I'm going to Cabo. We have a conference that we need to visit there, and I have a few clients that I'm going to meet with. Here's my flight reservation. Here's my hotel, and I plan to be there for 5 days. That proves intent. I have a paper trail to protect you in case of an audit, right? Now, as you go there, again, we want to make sure to document as much as possible. Document the meetings, document the time, everything that you could possibly do to show that you essentially had for first purpose to go there and handle business. And then while you were there, you just so happened to do some fun things for yourself and your family, right? The problem with the idea of just, having a podcast and then turning that into an entire tax write-off is that it will be very hard to prove that, first of all, it took you as much time on your trip to do that. And then the other side of things is that you typically have to show an economic benefit, right? So could it be argued that you didn't have to spend this much money to receive the benefit, the business benefit or the business purpose out of this trip? Is it possible that you could have shot this video or this podcast while at home doing it virtually, as opposed to spending $50,000 on a trip, right? So different things like that is what the IRS is probably going to bring up. And so in this day and age and with the number of audits that we see, I would definitely recommend caution, but don't just take that advice and run with it, right? You got to be extremely careful with how you document it and how you prove purpose, intent, and time spent.
What's the lesson about money that banks don't want people to know?
The rich, the wealthy, the wise make money off of debt. See, we've been conditioned to stay out of debt. However, now I maximize debt as leverage to increase my net worth. Why? Because I don't pay taxes on debt. So if I can profit through debt, I don't pay taxes on that. So the rich, the wealthy, the wise, they want to maximize the amount of money that they keep.
You got amazing advice, my friend.
Appreciate you,
Thank
brother.
you so much. Man.
Absolutely.
Okay, so that's a great one as well. One thing that is a fact is that you don't pay taxes on debt, right? Now, don't take this as financial advice. I'm not telling you to go out there and get more in debt, right? Essentially, what it is that you can leverage the debt to grow your business. When debt comes into your business, right, it is not considered taxable income because it's simply a liability, right? So one thing you have to keep in mind as a business owner is that you have two reports that are telling the story of your business. You have a profit and loss, and you have a balance sheet. Your profit and loss focuses on the revenue coming in and the expenses going out, while your balance sheet is showing your assets, liabilities, and equity in your business, right? When you borrow money, it's a balance sheet item. Cash goes up, liabilities also go up. you have a debt. There's nothing that happens on your profit and loss, which means there's no taxable event at that point. When you're repaying that debt, cash flow goes down, liability also goes down. So technically, you can't have a tax write-off for something that you didn't get taxed on to begin with. The only thing that you'll be able to write off is the interest portion of that repayment, right? So you have interest and principal. The principal goes towards the liability to turn that to reduce that amount, but then your expenses would increase the amount of expenses you have in your business, lowering your taxable income, right? And so by leveraging debt, you get an opportunity to grow your business and, by the way, create more income and profit, which you will get taxed on. But you don't get taxed on the debt initially when it comes in. And that is what is being explained in this video.
Real estate is for tax and it's for long-term wealth. So it's where you go to have savings in tax and have long-term wealth, not accumulation, but preservation. So we go there to skip the IRS and we go to real estate so that long-term I have more safe assets. Stock market we do to beat inflation. So we want 10% sort of max per year. That's why we invest in the stock market. Neither of these two things, unless you have a ton of money, are going to make you rich.
Right. Let's get 20 million in one of them.
Exactly. Then you can, if you have a ton of money, these two things are great, which is why most people who are really, really wealthy own a ton of this after they've made their money.
Yes.
The only way that you're really going to make your money is by starting or buying businesses. And so, in my opinion, this is where you put the $250,000 to $500,000 because you can have an infinite return on it.
Yeah.
You can't make real estate make you 50x return in 1 year. I mean, unless you have some crazy deal. But in buying a business, you can.
Yes, so I almost 100% agree with this video, right? So the tax treatment between you owning and starting a business compared to what happens with real estate and stock is extremely different, right? Real estate is where we're buying an asset using mostly debt. We get an asset that then brings us a bunch of depreciation and offsets our income if we have the proper structure, right? Either a real estate professional or short-term rentals. There's ways around it because you don't want to be capped by the passive loss limitation. But essentially, real estate allows you to preserve that wealth after you've created it. When the money is there, it creates tax write-offs that you can use to offset the rest of your income. On the flip side, your stocks, as you're investing in the stock market, the money continues to grow, but does not create a taxable event until you take the money out, right? So as the money continues to grow, you get more wealth, you become wealthier, right? Technically, you have more money on paper because the money is there and the stock continues to grow, but there's no tax event until you decide to take out the money out of the stock market. And at that point, you would have a taxable event on the gain. That is very different from running a business where anything can really happen and you have a lot more control, right? So you're starting a business, you grow the business, you make your money, but the best way to preserve it would be to move into those different investments, right? To be able to preserve the wealth that you've built through the business. And so taxed very differently. And that is why most of the seven-figure entrepreneurs that we work with love the idea of going into real estate after they've made so much money into their business. All right. And so a lot of the times when I get, exposed to those videos, what people are essentially asking me is this genius or is this tax fraud, right? And so my idea is to, really understand why people are, mentioning that potential advice. And a lot of the times the advice is good, just not enough detail, just not enough background supporting exactly how you're supposed to do it, which is the reason why having a tax strategist working with you is the best way to make sure that you're doing things in a tax efficient manner, but also in a legal manner. And so that is the main reason why having a tax strategist, being involved with you and helping you make those tax efficient decisions is extremely important. And so if you don't have anyone helping you with that, let's talk. SimplifyMyNumbers.com. One of our tax strategists can give you a call and discuss your personal situation and seeing how we can help. And so hopefully this gave you a few nuggets that you can implement in your business, and we'll see you next time in our next episode. Thanks for listening to Simplify My Numbers. If you found value in today's episode, there are 3 things you can do to support the show. 1, subscribe so you never miss a strategy to protect your profits. 2, leave a review on Apple or Spotify. It helps us reach more founders just like you. And 3, share this episode with one fellow member of the 765 community, someone you know who's working hard but losing too much to tax inefficiency. Remember, your chaos is our comfort zone. We'll see you next time.
This show is part of the ICT Podcast Network. For more information, visit ictpod.net.